Welcome back to our course on economic environment and business strategy. So in this session, we shift our focus from monetary policy to another vital instrument of macroeconomic management, that is fiscal policy. Fiscal policy refers to the government's use of taxation, public expenditure and borrowing to influence the overall direction of the economy. It plays a critical role not only in promoting economic growth and stability, but also in redistributing resources and correcting market failures. So in today's session, this is mainly structured to help you to understand the strategic logic and operational components of fiscal policy. So specifically, we will cover in this session first the core objectives and conceptual foundation of fiscal policy, and followed by the main policy instruments, government spending, taxation and public debt management. And then we will cover the structure of India's union budget, including revenue and capital accounts, then about the various types of budget deficits and what they reveal about the fiscal health of an economy. And finally, the political economy of fiscal policy making, drawing insights from the public choice theory and partisan theory. So for businesses, understanding fiscal policy is essential because it shapes the public investment, tax regime, infrastructure development and overall demand conditions. And these are all key factors that directly influence business strategy and market performance. So let's begin by unpacking the core principles and instruments of fiscal policy and see how they shape the economic landscape in which firms operate. So coming to the concept and business implication of the fiscal policy. So let's begin with what is meant by fiscal policy. So fiscal policy means the use of government spending and taxation to influence the economy. So the core objectives of fiscal policy is to ensure stabilization, ensure economic growth and also for redistribution of income from wealthy to poor. And this one, the fiscal policy is unlike monetary policy, fiscal policy can have direct impact on aggregate demand in the economy and also can make direct impact, immediate impact on sectoral activities in an economy. So let me now point out, list out different types of fiscal policy. So to begin with, we have expansionary fiscal policy. So expansionary fiscal policy means increase in government spending and or decline in taxes. So the main objective here by following an expansion fiscal policy is to stimulate demand conditions in the economy and thereby supports economic growth, especially during slowdowns. In other words, if the economy is going through a recessionary phase or if there is a slowdown, then at that time normally governments opt for an expansionary fiscal policy. That means increase in government expenditure, increase in subsidies and also reduce in taxes. So the idea is that people are having more income, and then as a result, when there is a declining tax, obviously you know that there is more purchasing power with the people, and that will stimulate aggregate demand in the economy and thereby support economic growth. And in contrast to this, there is contractionary fiscal policy. Contractionary fiscal policy means a decline in government spending or an increase in government taxes. So this one is done mainly to control inflation and also to reduce fiscal deficit. Normally when the economy is doing well or is at a peak, and at that time if there is an inflationary pressure is there, then at that time normally government they reduce government spending or they increase taxes so that the purchasing power of the people goes down, and then it can control inflation and also it can reduce fiscal deficit. In contrast to this, other one is neutral fiscal policy. That means a balanced spending and taxation. That means there is no expansionary, there is no increase in government spending over its revenue, but just try to maintain the current economic trajectory. So that means doing not making any government intervention to change the direction of the trajectory of the economy. So let me now list out the few key instruments of fiscal policy. First one is that is widely used. That one is called government expenditure. So the government expenditure, that is the spending by government, it can be categorized into two types. One is capital spending and the other one is revenue spending. So this is the government expenditure has impact on infrastructure development and social welfare, and also it can have a multiplier effect in the GDP growth. Then comes another key instrument is called taxation and subsidy policy. There are direct and indirect taxes which are used to influence the disposable income and business cost in an economy. So for example, government reduce tax. When the government reduce tax rates, that means the disposable income of the people increases. Similarly, when government reduce the tax on goods and services, indirect tax, that means the price will go down. That means the business cost will go down. Then there is third component, that is called borrowing and public debt management. So how government finance the budget deficit and how do they manage the public debt. So a key aspects in fiscal policy is government budget. So a budget means a government budget is a formal financial statement that presents government's estimated revenues and expenditure. That is, in other words, is a statement of the expected income and planned expenditure for a specific fiscal year. So it serves as a plan for how the government will raise money. That means through taxes, borrowing and other sources, and spend it on development, welfare and administrative activities. Unlike the personal budget or individual budget, a government budget started in this way. First, they estimate the expected expenditure for the next financial year, and then accordingly they also estimate the expected income. So in the case of individual, especially like individuals, what they do that first they calculate their income, and in general they plan their expenditure. In contrast to this, government in general overall, first they plan their expenditure and then they estimate the sources of their income or the revenue. Let us now go in depth by of understanding the government budget. So the union budget of Government of India has two main components. One is called revenue account and the other one is called capital account. So we have revenue account and capital accounts. So each account includes receipts, that means money coming in, and second one is expenditure, that is money going out. So the revenue account, it includes, one is revenue receipts, that includes taxes, non-tax revenues, etc. Then it has revenue expenditure, that including salaries, subsidies and interest payments. Then coming about the another account, the second account called the capital account, it again has two components, as you know, one is receipt and the other one is expenditure. So capital receipts include borrowings, loan recoveries, asset sales, and the capital expenditure includes infrastructure creations, loans and asset acquisition. So let us go in detail one by one and see what these concepts mean, what does it include. So let us go one by one. So begin with capital expenditure. So the capital expenditure means in the union budget, it includes the spending that create assets or reduce liabilities for the government. So the key components of capital expenditures are, one is construction of infrastructure. It includes roads, bridges, railways, airports, ports, dams, etc. So these are all the infrastructure development, that the spending on the development of this infrastructure is one main component of capital expenditure. Then second one is building on public facilities including schools, colleges and hospitals. And then comes acquisition of machinery and defense equipment, that also come under capital expenditure. Then investment that generate future income or dividends, and then loans and advances to state, union territories, government companies and other entities, that are also part of capital expenditure. Let's now move to revenue expenditure. The revenue expenditure is the spending that doesn't create any assets. This has been used for the day-to-day functioning of the government's department. That's mainly making the salary payments and pensions and other operational expenses. So the main components, as I mentioned already, it includes mainly for the use for the day-to-day working of the government's departments, that including salaries, pensions and operational expenses. It also includes the interest payments on public debt, and also it includes subsidies, including food subsidy, fertilizer subsidy, fuel subsidies, etc. In addition, the grants to states and union territories, even if used to create assets, this also part of revenue expenditure. Let us now move to the other component, that is the capital and revenue, the receipt component of government budget. So it again, as I mentioned here, it has two cover aspects. One is capital receipt and the other one is revenue receipts. So the capital receipts includes non-recurring receipts of the government that either create liabilities or reduce assets. They do not affect the government's revenue or fiscal balance directly in terms of day-to-day operations. So the one key component of capital receipt is government borrowings, that is market loans from the public, and borrowing from RBI and other parties through treasury bills, and also loans from foreign governments and international bodies. All these become a key component of capital receipts: market loans, borrowing from RBI and loans from foreign governments and international bodies. In addition, the second component is disinvestment receipts, that is by sale of government stakes in public sector units. You know, the recent sale of Air India to Tatas and LIC. These are all selling the share of LIC by the government. These are all part of capital receipts of the government, and this has been named as disinvestment receipts. Then the third category is loan recoveries. It includes repayments from state and union territory governments, and also it includes recoveries from government companies and other parties. Let's now talk about revenue receipts. Revenue receipts are recurring receipts of the government that neither create liabilities nor reduce assets. So they are mainly used to finance the routine or operational expenditure of the government. So the key points to remember here that it comprises tax revenue, including income tax, GST, customs duties and other non-tax revenues, including interest received, dividends, fees and fines. So revenue receipts means mostly in India, it consists of tax revenues and also to some extent are non-tax revenues. And it doesn't create liabilities. That means there is no future repayment is required. So where the future repayment is required, that will come under the capital receipt, not under the revenue receipt. Then it doesn't reduce assets. So the capital receipts do not reduce asset. That means no asset sale involved in the revenue receipts component. So I am showing you the view of the budget, the key receipts and expenditure components. So the revenue receipts that you can see, this is the revenue receipts. So you can read it here: tax revenue, non-tax revenue. So over time, from start in this table, I'm showing you the figures starting from 2023-24 budget to 2025 to 26 budget. So you can see the changes in the values. And the capital receipts, you can see here the components: recovery of loans, other receipts, borrowing and other liabilities. So this is the main component you can see from this. So you can see in the capital receipt, tax revenue is the main component, and in the revenue receipt you can see tax revenue is the main component, whereas in capital receipt, you can see borrowing and other liabilities are the main component of capital receipts. So the total receipt is given here, and you can turn on to item number 9, where the total expenditure is given, that is 10 plus this plus revenue account plus capital account. These are the total expenditure of the government. So I am also showing you for an illustrative purpose, allocation of government expenditure and government revenue. You can see the rupees come from, that means of the total budget, you can see that 22% is coming from income tax and corporation tax, that the taxes on companies, corporations, profit tax. On the profits of the companies, it comes 17%. That means out of 1 rupee, you can see 17 paise is from corporation tax. And borrowing, it constitutes lion's share, that means market borrowing by the government. It constitutes 20% of the government budget. That means of the total expenditure of the country, 1/4 is financed through borrowing from the market. Then other component, of course, you can go through here. The GST is now 18%. And then this is the income source. Then what about the spending parts? On the spending part, rupee goes to, you can see that since you already seen here that on the revenue side, we have seen that borrowing and other liabilities constitute 24% of the total budget. Now here on the expenditure side, you can see interest payment is 20% of the total expenditure. So that means 20% of the total expenditure, total government budget is spent for just for interest payment. And then you can see other components here, central sector schemes, defense is 8%, state government share of taxes and duties, it is 22%. So let's now move to some related concept with the budget, that is called budget deficit. A budget deficit occurs when a government's total expenditures exceed its total revenues, excluding borrowing. You need to exclude borrowing during a specific fiscal year. It reflects the shortfall between what the government earns and what it spends. So most government across the globe, they follow deficit budget. They have deficit budget, except some European countries, Scandinavian countries, they have surplus budget. So in budget deficit means the government's total expenditure is greater than government's total revenue. So in Indian budget, especially in Indian context, we use 4 related concepts, 4 types of budget deficit. One is called revenue deficit. Second, another one is called effective revenue deficit, and fiscal deficit, and primary deficit. So let us go each of these concepts to get a clear idea what does it mean. So coming to the revenue deficit, and revenue deficit occurs when revenue expenditure exceeds revenue receipts. So we have already defined what are revenue expenditure and what are the components of revenue receipts. So simply the formula here is that revenue deficit means revenue expenditure minus revenue receipts. So that is revenue deficit. So let us identify the key points here. The revenue deficit, it shows that government's earnings are insufficient to meet its routine, its day-to-day operation, its day-to-day functioning. So it includes transactions that affect current income and expenditure of the government. So you can see that a persistent revenue deficit forces the government to borrow to meet operational needs. For example, to pay salaries of the government employees and also to make pension payment to the retired employees. When government's earnings are insufficient, it needs to borrow from the market. Then at that time, you can see that the revenue deficit, that the revenue expenditure is greater than revenue receipts. So normally, let us also see how revenue deficit is met. So one of the sources is borrowing or disinvestment. So that means financing the deficit through capital receipts. That is one source. That means mainly financing the deficit through capital receipts. And second one is that since revenue deficit means revenue expenditure is greater than revenue receipts. So in order to reduce this deficit, one option is to increase revenue receipt. That means increase in revenue, raising tax or non-tax receipts so that the revenue receipts increases. Then the second one is rationalization of expenditure, that is reducing unnecessary spending. So there are several implications of the revenue deficit that often financed through capital receipts such as borrowing or assets, and rising borrowing increase the interest and repayment burden, potentially worsening future revenue deficits. And the second related concept is called effective revenue deficit, and it measures revenue deficit after excluding grants used for creating capital assets. So this is the formal definition for that. So there is one point to note here. Grants for creation of capital assets are grants in aid provided by the central government to states, constitutional bodies, or implementing agencies for creating assets owned by those entities. Then another key concept which has been widely used whenever we refer to budget deficit, that one is called fiscal deficit. So fiscal deficit indicates the overall borrowing requirement of the government. So in a way, the total borrowing requirements of the government in a financial year are equal to the fiscal deficit in that year. So the formula to calculate fiscal deficit is total expenditure minus revenue receipts plus non-debt capital receipts. So you already know what a total expenditure and what is the revenue receipts. So this deficit, when there's a gap, there's a deficit is there. This one is because when government is spending, it has to finance it. So the way to finance it is through market borrowing. That means fiscal deficit, in short, simply means the overall borrowing requirements of the government. So when the government's expenditure exceeds its income, then the government needs to borrow from the markets. Normally, this difference is calculated in absolute terms. One I mentioned in one of the previous slide. Of the total budget, government 24% of the total budget is the total expenditure is financed by borrowing. That means 24% of the total expenditure is met through borrowing from the market, and also expressed as a percentage of the GDP. Then another concept that is derived from the fiscal deficit, that called the borrowing requirements of the government, that one the fiscal deficit, excluding interest payments. So that means the primary deficit is called the primary deficit. That means fiscal deficit minus interest payments on previous borrowing. So the clear here, it means because fiscal deficit means the borrowing, but out of that, if you exclude the interest payment, then whatever we are getting is that the borrowing that are available for productive purposes, not just for servicing past debt. And if the primary deficit is zero, it means all borrowings are only used to pay interest and no extra borrowing goes towards new expenditure. So I am also showing you some statistics from Union Budget of India about fiscal deficit. You can see the percentage of GDP. It was 5.6% in 2023-24. Is now 4.4% in 2025-26. Similarly, revenue deficit, effective revenue deficit, primary deficit. You can see the data and the trend. I'm also showing you some statistics on sources of financing fiscal deficit. I hope these are all self-explanatory. You please go through that, and also you always go through the latest financial budget document. You will get all this data from there. Also, I'm showing you the trend in deficit, and you can see during COVID time, you can see that there is a sharp rise, especially here you can see there's a sharp rise in deficit trend. And prior to that, you can see that at one point of time, the deficit finance, the fiscal deficit was 3.5, for instance, in 2016-17, but during COVID time, it became 9.2, and now in 2026, it's 4.4%. And this is another measure to express the debt, that is the debt to GDP ratio. Debt to GDP ratio, that is the total debt divided by gross domestic product. So I'm also listing out here some of the implications of growing budget deficit on business conditions. One, it would adversely affect the sovereign credit rating, the ratings of the government by the borrowing agency. That means the fiscal position of the government is weak. So that means the overall fiscal management is also considered to be weak. So persistent deficit can lower sovereign rating, and so you know that when there is deficit is more, that means government is borrowing more and more from the market, then the borrowing cost, the rate of interest also increases. So as a result, you can see interest rates and borrowing cost increases is also called as crowding out effect on private investment, because when government increases the borrowing from the market, then the demand for loanable fund increases. That means as a result, you can see that the price of bond will decline and the interest on bond will increase. Similarly, there are also adverse implication on foreign direct investment. Fiscal stress and currency depreciation risk reduce investor confidence and foreign direct investment inflow. And it also adversely affect GDP growth. Maybe it may stimulate short-term economic growth, but it hinders long-term growth through debt and inflation. It also has pressure on inflation and also on foreign exchange rate and also on future fiscal sustainability. So let us also contextualize the fiscal policy in the Indian context. In India's fiscal policy is mainly guided by FRBM Act of 2003, and this act was designed to bring greater discipline, financial discipline, transparency and long-term sustainability of India's fiscal policy. So it sets targets for reducing fiscal deficit and public debt, while also promoting accountability through regular reporting and parliamentary oversight. And we talk more about the receipts, expenditure and receipt part. On the receipt part, especially on the revenue receipt part, one of the term we use is taxation. I thought it's better to list out what are the different types of taxes. Broadly, there are two types of taxes are there. One is called direct tax, the other one is called indirect tax. And direct taxes are levied on a person's or firm's income or wealth, thus paid directly by the person or firm on whom the assessment is made. For example, the income tax, and similarly the corporation tax paid by corporation on their profit. So here the incidence and burden will be of direct tax will be on same person or firm. And in contrast to this, indirect tax are the taxes on spending on goods and services. Here, person on which it is imposed, but that person may, suppose it is imposed on a firm, for example, excise duty that is imposed on the production side, then firms initially pay, but firms will transfer this burden, this tax to the consumer through higher prices. Then the burden will be transferred to consumers. So these are the examples of indirect tax. So I have listed out the advantage and disadvantage of direct taxation and indirect taxation here. I am also introducing a concept called Laffer curve. It shows how much tax revenues raise at each possible tax rate. So suppose the idea is that when government increases tax rate, we assume that government's tax revenue is going to increase, but there is a threshold. You can see on the x-axis, you can see when we keep on increasing the tax rate, there is a threshold that it is there. Afterwards, because if higher the tax, if suppose you need to pay 50% or 60% or 70% of your income as tax, then it will negatively affect your motivation to work. Then as a result, the tax revenue, initially it increases to certain position, but then afterwards it started declining. So this is relating the tax rate and tax revenue. So there is another related concept that is called Ricardian equivalence. That means, the simple meaning of Ricardian equivalence means, suppose if you are getting a tax cut or tax subsidy, but you are aware that if you are getting a tax cut or subsidy today, in the future government is going to increase tax. So because of that, normally this has been implemented mainly to create a stimulation to stimulate the economy, but people understand that if government is reducing tax or reducing deficit today, in the future they are going to increase the tax. So as a result, people would save a part of their income, then because they know that in the future they need to pay it back to the government. So that means households internalize the debt, they anticipate future tax increases and save more now. This means there is no role for fiscal stimulus. In the short term, there will be a slight impact, but however it will be neutralized because people would anticipate that in the future they need to pay more tax if they are getting spending or subsidy, some payment from government if they are getting, they know that in the future they need to pay it back. So let me also conclude this session by giving some strands of literature, the two key strands in literature on optimal fiscal policy. One is guided by public choice theory. The proponents of public choice theory argues that policymakers act to maximize their own political welfare, not always social welfare. And another theory called partisan theory, they argue that the political ideology shapes fiscal decision. For instance, liberal political parties vis-a-vis conservative political parties. Liberal political parties, they give more subsidies, they go for more social security payments, whereas conservative, they go for more incentivizing on the supply side of the economy, more tax rebate for the corporations and other productive units. So the common theme here is that politics strongly influences macroeconomic policy making. So coming to the public choice theory, these are the key aspects. Voters are myopic. Voting behavior responds to short-term economic conditions. So that leads to political business cycle. That means the pre-election demand surges followed by post-election inflation. And similarly, unemployment versus inflation. Politicians prioritize avoiding unemployment over controlling inflation. So fiscal policy has an inflationary bias as compared to monetary policy. And there is a deficit bias as well. Politicians prefer spending for visible benefits rather than raising taxes. So there will be a persistent budget deficit, especially just before during the election period. Then the second theorem is called partisan theory. It means there's a party cycle is there. Liberal parties, they favor employment and redistribution benefits. They follow an expansionary policy, whereas conservative parties are normally known for prioritizing price stability and also following more restrictive policy. So the implication of this one is that changes in ruling parties create cyclical fiscal policies. So the fiscal rules that the balanced budget can reduce political manipulation of aggregate demand. So overall in this session we have discussed what are the various fiscal policy instruments. Then we distinguish between different types of receipts and expenditure. Then also we related it with the India budget. And thank you for listening to this session. And in the next session we'll talk about the open economy model, then how it's related to business, economic environment and strategy. Thank you.